I'm gonna use a real life example for you guys. So say somebody's gonna go in and they're gonna buy a $700,000 house and they're gonna put down 50 something grand to keep you at a conventional loan limit. So let's say I get a $647,000 loan. Let's say the market interest rate is 6%, just for an easy number. It's 30-year fixed loan, number of payments, 12 payments a year. Principal and interest payment is $3,800 a month, okay? Principal and interest. So you have three different programs down here. So on the first one I want to talk to you about is the 3-2-1. What this is basically somebody says, you know what? I know that I'll be able to likely refinance in 2 years or 3 years to a much lower interest rate. And you have a seller that really wants to sell a property, but the buyer is like, I don't want to buy that property. The payment's way too high. This is a rad program to be able to do it. So let's say a house is listed at $700,000, right? And instead of offering $670,000, you have the seller do a seller concession for 28 grand. I'm going to show you why this is way better. A price reduction of $30,000 is only going to take down their payment in a ballpark. You're talking 30 grand, take them down the payment about 180 bucks a month. What I'm going to show you guys is how to get their first year payments down to 1,000 below, second year payments down 800 below, and third year down $400 below market. So they save $28,000 in payments roughly over that period of time. So the way it works is in year one of that mortgage, even though their rate is 6%, they only have to pay a 3% mortgage interest rate. So that 3% rate in 3-2-1 means year one, it starts 3% below the real rate, year two, 2% below the year rate, and then the last year, 1% below the year rate. This is not getting added to the back end of the loan. What you're basically doing is having the seller pay that buy down cost to allow that buyer to act like in year one, the rate's 3%, year two, it's 4%, year three, it's 5%. And then by that time, within that 2 year to 3 year window, they're very likely to be able to refinance to get out of that 6% loan. There's no prepayment penalties. It's a normal conventional loan, right? So they're able to get that down. So what you're going to see here is in year one, instead of that payment being $3,800 a month principal and interest, that payment is down to only $2,700 a month. So it's like they would have bought that home last year, 3% interest rate. You have that for all 12 months. Then call it June of 2023, that payment goes to $3,089 a month. So it's still $790 below where it would normally be. And then lastly, you have that payment in the third year. So June of 2024, for that whole year, that payment's $3,474, $400 a month less than what it would have been, at that beginning of time. So the buyer is actually paying $28,000 less over the 3 years of having that home. That is actually subsidized by the seller giving him a concession. So if a seller sells a house at $670, or a seller sells that house at $700 and gives them $30,000 back towards this, the seller still walks with the same amount of money. But the difference is this person wants to buy that house because they're going to have a mortgage payment of only $2,700, then $3,089, and you educate your clients. You say, hey, guess what? Every time the feds raise rates, within that about 18 months from that last one, we've seen mortgage rates really fall. You have a 3% rate for year one, a 4% rate for year two, 5% rate for year three. So you have 3 years to refinance and hope that rates are, get down to 5% or less. And if they don't, well, guess what? Rates are higher. You're still at a 6% interest rate, and that's fixed for the remaining period of time. And that's for somebody that really wants the longest cushion. Or what's my favorite is a 2-1 buy, because I know that you're going to be able to refinance within about 18 months to get a much lower rate. So year one, it's a 6% rate. You have a 4% interest rate for that year. Year two, 5% interest rate for that entire year. So that seller basically pays the buyer 15 grand to put towards their closing costs. The buyer makes a mortgage payment, $800 a month less for the first year, about $400 a month less for the second year. They refinance, within 24 months, hopefully getting an interest rate in the mid to high fours. And guess what? They never even had to pay that $3,800 payment. And they end up probably getting a mortgage interest rate, probably $3,200 a month. And they didn't even have to spend all that out of pocket. And lastly, you have a 1 year buy down. Rather than a 6% interest rate, they can go 5%. They say, hey, you know what? Either one, I'm only going to keep this house for a year or two, or two, you know what? I really think that mortgage interest rates are going to be 1% lower for a year. The seller only wants to get, then for about a $5,000 buy down, that buyer basically has a $400 a month mortgage payment. So this is a really cool program available on conventional loans. So, obviously you don't want the buyer paying for this because you might as well just keep their money in the bank and subsidize the shorter payments. This is a great way as a seller or as a listing agent, or as even as a buyer's agent, hey, I'm willing to pay $700,000 for that house because right now comps are still using comps for March and April, so appraisals aren't having any issues. So hey, we'll make an offer at $700,000, but I want a $15,000 closing cost credit to my buyers. Now my buyer gets a 4% rate, and then obviously a 5% rate there. So hope that kind of gives you a good idea, on that as well.